From Deloitte Tax, welcome to the Tax News and Views podcast. In this series, we talk to specialists from Deloitte about the latest business issues and developments. I'm Carrie Falkenhayn, your host for Tax News and Views. And today we're going to be talking about how tax departments can add value to their organizations, especially in times of economic uncertainty, through opportunities that we will refer to as tax value services. Joining me today are two of my Deloitte colleagues, Lindsay Whitfield and Chad Boyd. Lindsay is a partner in Deloitte's M&A Transaction Services Group, and Chad is a principal in Deloitte's Transactions and Integrated Services Group. Chad and Lindsay, welcome to the podcast.
Thanks, Carrie, for having us.
Hey, Carrie. Appreciate you having us.
So, Lindsay, I'll start with you. Maybe tell us a little bit more about what we mean by tax value services and why they're so relevant in the market right now.
Yeah, absolutely. So tax value services are really centered around how companies can use tax planning to get ahead of market and economic pressures. It's really as simple as that. And in today's environment, there are certainly a lot of market and economic conditions that are leaving companies feeling a variety of pressures. And there are a lot of ways that companies can use tax planning in order to get ahead of those pressures. First, I'll talk a little bit about what types of pressures we really mean when we talk about tax value services. So there are certainly the financial pressures that we see a lot of companies facing right now in today's environment, which are really centered around the high interest rates and inflation and those environments that we're seeing. In a lot of ways, this leaves companies looking for ways to generate cash savings. And there's very clearly a lot of tax opportunities when we think about generating cash savings. We also see that clients are facing a lot of integration challenges. We went through an M&A boom really from 2020 to 2022. And a lot of companies now are looking at ways to better internally align their processes, maybe simplify processes, and that's driving a lot of change and pressures internally for companies. We also see a lot of activist shareholders that are creating pressures for businesses to change operations, improve structures, and drive results. And with those types of pressures, again, tax planning becomes important. Lastly, it's important for companies who are facing all of these various pressures to think about tax early in the decision process, and we can talk about that more today. But the goal is really with tax value services to avoid surprise tax costs and help companies identify tax planning opportunities, again, with the tax planning.
So that's great background. Maybe take us a little bit deeper into how tax can be a strategic priority for a company that's facing the economic uncertainty that you described.
Yeah, absolutely. So the way I think about this is really to look at three strategic buckets. The first bucket that a lot of companies tend to start with is really looking for more of the short-term strategies that companies can take to drive tax value. A lot of these short-term strategies are centered around identifying areas of cash tax savings. We can get into more of the detailed nuances as we go today, but often these shorter term strategies involve identifying maybe tax refunds or changes to tax methods that can provide a more immediate tax savings for companies. Second, a lot of times we see companies who are facing economic uncertainty begin to run various scenarios as they're planning for operations. A lot of times that leads to potential transactions. This may look like selling off unwanted or underperforming assets. Perhaps sometimes it may look to acquiring a business in a supply chain to improve operations. And when companies turn to transactions, it's key for tax planning to be at the center of that in order to really understand what the tax costs of those transactions are and what opportunities there are to drive tax benefits. The third bucket is really more of a long-term strategic play that companies can look at to drive tax value. A lot of times these long-term tax strategies can include things like redesigning a company's tax department, potentially including and implementing new tools and technologies to improve processes. Sometimes we see companies look at realigning business operations and looking at transfer pricing policies and savings. These types of planning tools are often more complex to implement, but can definitely generate a lot of tax savings year over year once they're achieved. We see companies kind of look at all of these all together, but companies start small with the shorter term tax planning, and then perhaps start to look at more ways to achieve a sophisticated tax plan with a long term vision.
So that's helpful to understand the areas where there's tax savings. So thank you, Lindsay, for that. But Jen, maybe you can tell us, I mean, we hear about corporations or organizations that are facing economic uncertainty, and they'll have initiatives centered around cash savings. And oftentimes it is much broader than tax. So any insights you can share with us around how tax can add value to some of those types of initiatives?
Thanks for the question, Carrie. Yeah, there's no doubt that companies need to save money right now, and cash is important, right? There's usually three pillars that companies look at when they're trying to pull cash or drive savings through the business. One of them is around headcount, which is traditionally the biggest driver. The other one is just general spend. And usually that focuses around discretionary items, but it's also other items that hit the P&L. And last, it's around working capital improvement. And that's everything from procure to pay to order to cash. It's really trying to unlock that tied up capital that's on a balance sheet and drive those. Tax has an ability to drive value in each one of those. Also, obviously, the headcount needs no explanation, but also through OpEx, there's a lot of items that Lindsay was touching on that are not the traditional tax expense items that are driven by the tax department or under their purview. The last is working capital, right? And obviously, again, tax expense is a huge item. The cash tax payout for a company is significant quarter over quarter, but there's other items that the tax department can be involved in that can free up cash.
In your experience, what types of corporate initiatives should tax be involved in to make sure they're adding value?
Yeah, let me take a second just to talk a little bit about the different types of strategic initiatives, because there's quite a few of them and they have different names. There's ones that are just the traditional of, increasing earnings per share in a company. There's OpEx, takeout or reduction that companies have. There's cash flow improvement. Those are the ones that we're talking about that are strategic initiatives driven by a company where tax can add value. There's also a number of other ones that companies are undertaking right now as they integrate acquisitions, as Lindsay pointed out earlier, or just general business initiatives. Those are things like, an ERP upgrade implementation project. There's changes in go-to-market strategies that companies are implementing, whether it's a wholesale change or just changing to economic conditions of distribution models or so forth. Supply chain realignment. So the last one is around financing. There's tax items, deferral items that are differences between book and tax, which can lower the out-of-pocket cash tax payments currently. Yes, there'll be a makeup to that somewhere down the road, but it'll allow companies to increase their cash currently, pay down debt, and basically, forego that when interest, and hopefully with the interest rates going lower in the future.
So deferrals is one tactic. What is some other levers that companies can look at from a tax perspective to add value?
Yeah, as Lindsay pointed out a little earlier, there's a number of items that are, we call them short-term, medium-term, and kind of long-term. Goes without saying, right? There's certain ones that have a very low impact to business, but can drive value and see immediate benefits, right? Things around credits and incentives that are offered by the federal government or even state and local municipalities. Obviously, with the new tax law changes, there are even transferable credits. We're seeing companies going out into the open market and buying some of these credits for, I would say pennies on the dollar, but some discounted value that they're able to then to use to offset their own tax expense. That's one of them. I think we mentioned before, effective use of transfer pricing policies, right? You have an interquartile range that's accepted by most jurisdictions around the world, and effectively using those ranges to drive cash tax decreases. There's method planning. That's really more around the deferrals that we talked about. Longer term, you might look at legal entity simplification. As companies have been very acquisitive over the last few years, there's been significant integration that may not have happened, and you can reduce the out-of-pocket expense around compliance and your timing for, your month-end close, et cetera, by reducing the overall footprint of your global entities. Those are just a few of the ones. The other ones we see is around refund claims, especially around indirect taxes, VAT, GST outside the United States, and even sales and use tax inside the US. The one item that we've been touching on quite a bit that seems to drive a significant amount of value is around actually refunds, whether refund claims or even when you've had a underpayment of taxes. There's an interest component of that that's computed by the IRS. And typically it's off. And we've seen some significant either refunds of interest payments by companies or an increase in the interest that they receive on overpayments.
So you talked a little bit about legal entity simplification. That takes me back to a comment that Lindsay made earlier about oftentimes companies that are facing economic pressures might consider M&A transactions. Lindsay, maybe take us a little bit deeper into what companies should consider from a tax perspective if they are looking at an M&A transaction.
Yeah, absolutely. Thanks, Carrie. So similar with our theme for the day, I'll break it into three buckets. The first type of transaction, a lot of times we see companies consider is really on the divestiture side. So as I mentioned, sometimes when economic pressures are prevalent, a lot of companies may look for underperforming assets and looking at a carve-out transaction or a full-out sale in order to gain liquidity and help solve some of the economic pressures. In these situations, it's really important to consider what tax attributes are at play. And by tax attributes, often we see primarily net operating losses, but there can certainly be some carry forwards or other attributes similar to the credits and incentives that Chad talked about a few minutes ago. In those situations, it's critical to understand what happens to those tax attributes as the result of a divestiture. In some cases, the seller may be able to utilize those attributes as a way to offset potential tax gains and again, minimize that cash tax outlay. But in other situations and in other structures, a buyer may actually inherit those attributes. And so if that's the situation for the particular tax structure of the divestiture a company is looking for, it's important to understand the value of those attributes and make sure that that is being considered in the overall deal economics. With the idea of trying to use tax to generate value. The next type of acquisition that a lot of times comes to the table in an economic pressure situation is an acquisition. So the example that I gave previously is a supply chain play or potentially acquiring a competitor. A lot of times we'll see those situations as well in order to get ahead of an economic pressure. And oftentimes, a first critical question to think about from a tax perspective is whether there's an ability to generate additional tax attributes that can drive post-acquisition tax deductions and savings. Oftentimes, we see that there's an ability to structure a transaction in a way that gives rise to a reset of tax basis to fair market value. In those situations, companies can definitely use tax in order to generate true tax savings in the future from that M&A transaction. The last bucket really about M&A that we tend to see in these situations is more around internal restructuring transactions. So potentially not necessarily involving a third party, but companies looking at doing a transaction to simplify their structure, as Chad mentioned. So the legal entity simplification exercises we see often. There's always situations in this time with the high debt or high interest rates where there's also true distress in the system. And if there's true distress in the system, oftentimes that leads to debt restructuring exercises that companies have to go through. And again, you'll see a theme here across all of these, but a key and critical item to monitor in that situation, if you're looking at a debt restructuring transaction, would be, again, to understand how attributes are impacted by these transactions. If there's significant net operating losses that have been generated from distress, how those will survive a debt restructuring transaction. And then also keeping an eye on and understanding whether any modifications to your debt may result in incremental taxable income, cancellation of debt income that would be a result of debt restructuring. That's often a surprise that companies do not want to find and understand towards the end of a debt restructuring. So those are some of the key levers that companies need to be thinking about from an M&A lens.
Well, there's a lot to think about there. So thank you for that, Lindsay. Chad, maybe to help us wrap up, are there any ancillary benefits to having the tax department involved with projects like these?
Here, we hear from our clients all the time that tax departments want to get more involved in strategic initiatives, be more than just a compliance shop or a service center for the business. And we find that these types of projects can really raise the value of what they do. They're traditionally not involved in these projects. It's something that if they add some value or bring an idea, obviously the company's very happy about it. But getting them involved in and really kind of vetting out all these different ideas that we've thrown around can really demonstrate that the tax department is a true strategic partner for the business and not them. I'll call it traditional, compliance shop doing their everyday thing.
Well, thank you for that. Thank you, both of you, for giving our audience some important ideas on how tax departments can contribute to an organization's search for additional value levers. Really helpful. If people would like more information, you can go to Deloitte.com and you can search on M&A transaction services or transaction integration services, and you can learn more about some of our offerings there. You can also connect with Lindsay and Chad directly via LinkedIn. And as always, I hope you tune in here for future editions of Tax News and Views podcast. Thank you all so much for joining us, and I hope you all continue to be well. Take care, everyone.